What is Nassau Personal Income Annuity? Nassau Personal Income Annuity is a single premium indexed annuity designed to help address three of your retirement income needs. First, protection. Securing income for life with a guaranteed lifetime income benefit. Second, flexibility. Meeting your individual time horizon and needs. And third, growth. The potential for accumulating your contract value while protecting against market downturns. This annuity offers protection from market loss and lifetime income via choice of 2 guaranteed minimum withdrawal benefit riders. It offers a fixed interest account and 10 indexed accounts with index credits linked to the positive performance of 2 market indices, the S&P 500 and the CS Tactical Multi-Asset Indices. So, whether you want to begin guaranteed income soon after issue or at a future date, each rider offers guaranteed roll-ups. Your guaranteed income amount will depend on your income benefit base at age of issue, age at rider exercise, and whether you elect a single or spousal benefit. Depending on when you would like to begin taking income, you elect one of 2 income riders at the time your contract is issued. We will go into more detail about these riders in the next section. How does the personal income annuity help provide protection and security with a guaranteed lifetime income benefit? Nassau's personal income annuity offers the ability to choose from one of 2 income riders. They are called Income Strategy Today and Income Strategy Tomorrow riders. We will go over the current design of these 2 riders that are available with new annuity contracts today. If you are a current policyholder with one of these riders, your rider design may be different. You can always refer to your contract for how your specific rider works. Generally, the Income Strategy Today rider may be suitable if you plan to begin guaranteed income payments soon after contract issue. The Income Strategy Tomorrow rider may be suitable if you plan to wait several years or more before beginning guaranteed income payments. In both cases, your income benefit base grows each year you wait to exercise your rider for up to 20 years until you exercise it. Both riders allow you to choose when income payments begin, and you may begin taking income as soon as the youngest covered person is at least 50 years of age. What is your annual benefit amount and how is it determined? We'll answer that in the next section. But first, take a quick 1-question quiz.
What is your annual benefit amount? The term annual benefit amount refers to the guaranteed income payments provided by your income benefit rider. The annual benefit amount is a percentage of your income benefit base. The percentage is based on 3 factors. Whether you choose the Income Strategy Today or Income Strategy Tomorrow rider. Whether you choose the single life or spousal life rider option, and the age of the youngest covered person when the rider is exercised. Your producer can provide a table with these percentages to you. The applicable percentages will all appear in your contract. It's important to be aware that these percentages and income benefit base are solely used to determine your annual benefit amount. These amounts do not impact your contract value. So how do we determine the income benefit base? We'll cover that in the next section. But first, let's test your knowledge with a 1-quick-question quiz.
How does your income benefit base grow as part of the Income Strategy Today? Your income benefit base is an amount we use to determine your annual benefit amount and your rider fee. It has no actual cash value, so you can't withdraw it from your annuity. In this video, we cover how the income benefit base is determined for 2 of Nassau's income benefit riders, the Income Strategy Today and Income Strategy Tomorrow. Let's start with the Income Strategy Today rider. This rider includes a roll-up feature and adds an immediate bonus to your income benefit base. This income benefit base bonus is equal to 30% of your premium payment. So, when we issue your contract at your rider's income benefit base, it is equal to your premium payment amount plus an additional bonus, creating your initial income benefit base. Here's how it works. Assume you made an initial premium payment of $100,000 to your annuity. We multiply your $100,000 payment by 30% to get your benefit base bonus of $30,000. We then add these amounts together to arrive at an initial income benefit base of $130,000. Using simple interest, your income benefit base increases each year for up to 10 years as long as you have not yet exercised your rider. We call this increase a roll-up. We determine your roll-up amount on a simple calculation. We multiply your roll-up rate by your initial income benefit base, adjusted for any withdrawals. It's important to know that any withdrawals other than income provided by your rider can reduce your income benefit base and any future roll-ups, and therefore reduce your income benefit payment. The roll-up amount is then added to your income benefit base. For the Income Strategy Today rider, the roll-up rate is 5.77% for the first 2 years and 3% in years 3 through 10. Generally, this rider may be suitable if you plan guaranteed income payments soon after issue. At its core, the rider offers an initial benefit base bonus and a lower annual roll-up rate. As we discussed, when we issue the rider, your income benefit base is immediately increased by 30% income benefit base bonus. If you do not exercise your rider or take any withdrawals, the cumulative growth from your income benefit base bonus and roll-ups is 37.5% after 1 contract year and 45% after 2 contract years. Roll-ups continue for 10 years or until you exercise your rider, whichever happens first. Let's see how it works. Building on our prior example, assume you purchased an annuity with the Income Today strategy. For $100,000, your income benefit base at issue is $130,000 due to the 30% benefit base bonus. For simplicity, we will assume no withdrawals are taken from your annuity. That means that your initial income benefit base adjusted for withdrawals is also $130,000. Your income benefit base will grow on your first anniversary at a 5.77% roll-up rate. The roll-up is equal to that 5.77% roll-up rate multiplied by your adjusted initial income benefit base of $130,000. Your roll-up of $7,501 is added to your income benefit base, and your income benefit base increases to $137,501 at the start of your second contract year. Let's take a look at what happens on your second anniversary. Your income benefit base will also grow on your second anniversary at a 5.77% roll-up rate. The roll-up is equal to that 5.77% roll-up rate multiplied by your adjusted initial income benefit base of $130,000. Your roll-up of $7,501 is once again added to your income benefit base, and your income benefit base increases to $145,002 at the start of your third contract year. Now that you have an understanding of the Income Strategy Today income benefit base and how it grows over time, let's take a look at the Income Strategy Tomorrow rider. But first, let's test your knowledge with a quick one-question quiz.
Your income benefit base is an amount we use to determine your annual benefit amount and your rider fee. It has no actual cash value, so you can't withdraw it from your annuity. Generally, the Income Strategy Tomorrow rider may be suitable if you plan to wait several years or more before beginning guaranteed income payments. This rider includes a higher roll-up rate than Income Strategy Today and no income benefit base bonus. So if you purchase this rider, your income benefit base equals your premium amount at contract issue. If you made an initial premium payment of $100,000, Your income benefit base will also equal $100,000. Using simple interest, your income benefit base increases each year for up to 10 years as long as you have not yet exercised your rider. We call this increase a roll-up. Just like the Income Strategy Today rider, we determine your roll-up amount on a simple calculation. We multiply your roll-up rate by your initial income benefit base adjusted for any withdrawals. It's important to know that any withdrawals other than an income provided by your rider can reduce your income benefit base and any future roll-ups, and therefore reduces your income benefit payment. The roll-up amount is then added to your income benefit base. For the Income Strategy Tomorrow rider, the roll-up rate is 14%. Roll-ups continue for 10 years or until you exercise your rider, whichever happens first. After 10 years, if you've not yet exercised your rider, you may elect to continue roll-ups for another 10 years at a new roll-up rate. Your new rate is never less than 3%. Let's take a look at an example. Assume you purchased an annuity with the Income Strategy Tomorrow rider for $100,000. Your income benefit base at issue is $100,000 and there's no benefit base bonus. For simplicity, we will assume no withdrawals are taken from your annuity. That means that your initial income benefit base adjusted for withdrawals is also $100,000. Your income benefit base will grow on your first anniversary at a 14% roll-up rate. The roll-up rate is equal to that 14% roll-up rate multiplied by your adjusted initial income benefit base of $100,000. Your roll-up of $14,000 is added to your income benefit base, and your income benefit base increases to $114,000 at the start of your second contract year. Let's take a look at what happens on the second anniversary. Your income benefit base will grow on your second anniversary at a 14% roll-up rate. The roll-up is equal to that 14% roll-up rate multiplied by your initial income benefit base of $100,000. Your roll-up of $14,000 is added to your income benefit base, and your income benefit base increases to $128,000 at the start of your third contract year. If you do not take any withdrawals and have not yet exercised your rider, your benefit base grows to $240,000 after 10 years. What is the fee for these two income benefit riders? We'll cover that next, but first, take a short quiz.
The impact of withdrawals on your benefit base. You can withdraw additional money from your annuity. However, withdrawals that are not income benefit payments can reduce your income benefit and may be subject to surrender charges and a market value adjustment. It is important to know that your income benefit base will decrease. Therefore, your future roll-ups and future income benefit payments will decrease. Your income benefit decreases in the same proportion that your contract value decreases. For example, if you choose to withdraw 10% of your contract value before exercising your rider, your initial income benefit base, which is used to determine future roll-ups, and your current income benefit base, which is used to determine future benefit payments, will decrease by 10%. If you choose to withdraw your full contract value, then your income benefit base is fully reduced as well, and no further income benefits are paid. What kinds of withdrawals can reduce your income benefit? Any withdrawals, including required minimum distributions or RMDs, can reduce your income benefit if they're made prior to exercising your rider. After exercising your rider, any excess withdrawals, excluding RMDs, will reduce future guaranteed income payments. An excess withdrawal is a withdrawal that causes your cumulative withdrawals in that contract year to exceed your annual benefit amount. Surrender charges and market value adjustments may apply, and these may impact the benefit base. If you have to take an RMD, there are several things that you should consider. If you take an RMD before exercising your rider, your future income benefit will be reduced. If you choose to exercise your rider to satisfy your RMD requirements, your income benefit base will stop growing. If your RMD is greater than your annual benefit amount, you can take your RMD after exercising your rider without reducing your income benefit. What happens to your income benefit at other significant events? What happens to your income benefit on death? For the single life option, payments continue as long as the covered person is alive. Once the covered person dies, income payments stop and the rider terminates. No more rider fees are assessed. For the spousal life option, your spouse will need to elect to continue the contract as the new owner after your death. Then, payments will continue as long as the surviving covered person is alive. Once both covered persons have died, income payments stop and the rider terminates. No more rider fees are assessed. What happens to your income benefit when your contract value is reduced to zero? Your income payments will continue if your contract value is reduced to zero as a result of income payments or fees. If your contract value is reduced to zero for any withdrawals other than income payments will stop and your rider will terminate. What happens when you reach the contract maturity date under your annuity? You can continue to receive your income payments after the maturity date. Income payments will be made monthly and are equal to 1/12 of your annual benefit amount. Alternatively, you may exchange any remaining contract value for any annuity payment option provided by your contract. What is the fee for these riders? The Income Strategy Today and Income Strategy Tomorrow riders are available for an annual fee of 0.95%. At the end of each contract year, the fee is deducted from your contract value. The fee equals 0.95% multiplied by your income benefit base. The fee reduces your contract value and therefore reduces interest credited to the contract. It is important to note that as the value of your income benefit base grows, so too will the amount of the rider fee. If your income benefit base decreases, your fee decreases too. The rider fee may change if you elect to begin a new roll-up period. The rider fee may also change after the first 10 contract years. If the rider fee ever changes, it will never exceed the guaranteed maximum rider fee of 1.5%. You can choose to terminate your rider or surrender your annuity contract. No further income benefits are payable, and no further rider fees are assessed. However, you will be subject to pay for any rider fees owed for the amount of time elapsed between your most recent anniversary and the date of termination or surrender.